The average price of a home was about $170,000 in 2013. Today it stands at $400,000. That's about a 150% increase in the space of about a decade. Just for the sake of comparison, it took about 23 years for home prices to jump by 150% between 1980 and 2003. The housing market over the last 15 years has been one of the strongest in history, and at the same time as home prices have jumped by 150%, wages in the United States have only risen by 57%. Most people have not been able to keep up with the rising price of homes. Now, most people are aware of this and naturally hoping for this phenomenon to finally reverse so that housing can once again become affordable. But as I'm going to show you in this video, those wishes unfortunately might not come true, which could have disastrous consequences. By the way, there's currently a 30% discount on our service for St. Patrick's Day. In 2024, we had 85 winning trades averaging 16.65% gain each, and only 44 losing trades that averaged a 3.67% loss. With a 5% allocation per trade, that's about a 65% gain for 2024, which is 2 times the S&P 500's return over that same time period. We are very proud of these results that very few fund managers can actually achieve. Although the first part of 2025 has been choppier than last year, our mission at Bravos is to make sure that we're making every one of our clients as profitable as possible in markets. It's what we do day in, day out. So if you want to have access to all of our trades along with videos showing you everything I know about financial markets throughout the week, all for a ridiculously cheap price, well, now is the time to click the link in the description below. We can look at the ratio of home prices relative to wages in the United States to understand what's going on a deeper level. This is what that ratio looks like going back to the 1960s. Home prices back then were quite low relative to the average wage. Today, home prices are at the highest levels in history relative to wages, making this one of the most unaffordable housing markets of the last 60 years. Now, at a first glance, this might look like this is just an asset bubble that's waiting to pop, that a big deflation in the housing market is just waiting to happen, just like what happened following the 2008 housing bubble. In fact, this home price to wage ratio is at the exact same level today as it was at the very peak of the 2008 bubble. So let's try and understand if housing is really in a similar posture to what it was in 2007. One key characteristic of an asset bubble is that people take excessive risk through leverage. In the housing market, that leverage simply comes in the form of mortgage debt. Mortgage debt between 1950 and 2000 stayed below 50% of GDP. Then you can see during the housing bubble, that ratio went above 50%, and in 2007, mortgage debt represented about 75% of the total size of United States GDP. This excessive debt accumulation was a key component of the housing bubble in the early 2000s. Fast forward to today, and we don't really have evidence of similar behavior. Mortgage debt as percentage of GDP has been declining steadily since 2010. In fact, it even recently crossed below 50%. Now, when we compare this to the total value of the real estate market as percentage of GDP, we see that although the rise in real estate value in the early 2000s was most definitely fueled by excessive debt taking, today we've actually seen home prices rise without any kind of excessive debt taking. This is not what a traditional asset bubble looks like. Now, the logical thing would be to suppose that real estate prices have just gone up a little bit too far and that they're ready to revert to the mean. After all, when we look at personal savings in the United States as a percentage of GDP, it is currently sitting at one of the lowest levels since the period in the lead up to the financial crisis. This is one of the lowest levels of savings going back to the 1950s. If most Americans have no money saved up, it's hard to imagine that the housing market would continue rising in this kind of environment. Right? Well, believe it or not, we happen to think that home prices can continue rising regardless of how the average American feels. One of the reasons for this can be found on this chart right here. It shows us corporate profits that are being made per unit of production. Between the 1950s and 70s, the average amount of profit per unit of production stood quite steadily at around $0.02, according to the Federal Reserve's data. This margin of profit then proceeded to rise in the 1980s and has been rising even more aggressively over the course of the last 2 decades. In 2024, corporate profits per unit of production stood at $0.2, about 10 times more than what it was 50 years ago. Now, you might be wondering, what does this have to do with the housing market? Well, in dollar terms, these profits in the third quarter of 2024 amounted to about $3.5 trillion. Now, most of these corporate profits are then reinvested into capital that can generate a return on investment. So today we have an unprecedented amount of money that is flowing directly into financial capital. This is part of the fuel that has driven the 61% move up in the stock market since 2022, the 75% move up in gold prices, and the 58% return on private equity. And let's not even mention cryptocurrencies. Most asset prices have seen close to triple-digit increases over the course of the last 2 years. The housing market, on the other hand, has been pretty much flat over the same time period. It has even grown less than the average wage since 2022. This is very unusual. Typically, the housing market and the stock market trade very closely to one another. They both very broadly tend to move up and down together. The divergence between the stock market and real estate prices that we're seeing today is an anomaly. And as traders, when we see this kind of divergence, alarm bells start ringing. We've been long on stocks, gold, and crypto over the course of the last year, which has been very profitable given their bull market. The key to our trading style is to be invested in the strongest areas of the market at all times. And today, the divergence that we have between the stock and real estate markets suggests there's an opportunity that's forming, because this is not the first time that we've seen this happen. When we look at the stock market against the housing market in the late 1990s, we actually had a very similar divergence develop. Home prices pretty much stayed flat despite the stock market embarking on a very aggressive bull market, generating huge returns for investors. But as the stock market reached extreme levels of performance in 1998 and 1999 and was getting very expensive, the housing market finally began to pick up some steam and accelerate higher. In financial markets, this is what you call rotation. Investors will rotate their allocation from certain assets to others, depending on their economic outlook, but also just based on whether one has gotten too expensive relative to the other. We have another example of this type of divergence in 2012. The stock market had jumped by 110% between 2009 and 2012. Over the same time period, real estate prices actually declined. It's very likely that many stockholders used the profits that they received from the appreciation in stock prices and invested it into real estate that was quite cheap at the time. This is where we think we are right now. Stock prices have returned almost triple-digit returns since late 2022 and have reached the highest valuations since 1999. We think there's a good chance that the housing market actually begins to catch up to the rest of financial assets. That could suggest as much as a 50% rise in the price of homes over the course of the next few years, something comparable to what we saw between 2019 and 2022. If this were to actually happen, it would be devastating to most people that already cannot afford a home at current prices. Housing unaffordability is already at all-time highs today, with the average mortgage expense currently representing 40% of the median household income. If home prices were to rise further, it could lead to an even more expensive average mortgage payment, which would officially make housing completely unattainable to an entire portion of the population. As a disclaimer, I do want to highlight that this is just our opinion, and nobody knows what's going to happen in the future. But as traders, we're betting on this scenario right now, and we're taking our clients through that bet. When the timing is right, we'll be initiating a leveraged long trade on a real estate investment fund ETF that tracks the real estate market. Again, if you want to follow this trade and have access to all of our other trades, make sure not to miss the discount that we're doing for St. Patrick's Day. I look forward to seeing you join our community. See you next time.